Welcome to this explainer. Today, we're diving headfirst into the business of aging. Specifically, we're going to unpack how Ventas achieved an absolute landmark here in 2025 and what their freshly released numbers reveal about the booming longevity economy. So, let's get right into it. Think about this for a second. How exactly does a real estate giant grow its net income by 184% in a single year? I mean, in the mature, often slow-moving world of real estate investment trusts, or REITs, a jump like that is nothing short of staggering. Today, we're going to break down exactly how they pulled it off, where all that cash is coming from, and most importantly, where it's going next. So, the company we're looking at is Ventas, trading on the New York Stock Exchange under the ticker VTR. They're an S&P 500 company, and they play a massive, absolutely essential role in the longevity economy. We're talking about a portfolio of around 1,400 properties spread across North America and the UK. And what's really fascinating here is that this portfolio represents more than just buildings, right? It represents environments specifically tailored for an aging population. That includes over 850 senior housing communities alongside outpatient medical buildings and research centers. But before we even get into the operational weeds, let's just look at the bottom line for shareholders. The Ventas Board of Directors just declared an 8% increase in their quarterly dividend, bringing it up to 52 cents per common share. In the financial world, a dividend hike of this size, it isn't just a nice little bonus for investors. It's a massive, flashing signal of management's confidence in their current cash flow and their future outlook. You just don't raise the dividend by 8% unless the underlying engine is firing on all cylinders. Section 1. The 2025 Financial Highlights. Okay, so the real headline grabber is the attributable net income per share. It jumped from 19 cents in 2024 all the way to 54 cents in 2025. That is that staggering 184% year-over-year increase we talked about right at the start. It's just a massive leap in profitability. But, if you follow real estate, you know that net income only really tells part of the story, mainly because of how depreciation works on physical buildings. To really understand a REIT's performance, we have to look at FFO. Normalized funds from operations. FFO is literally the gold standard metric for REITs. It represents net income, sure, but it strips out real estate depreciation and specific non-recurring or non-cash items. Because think about it, buildings depreciate on paper for tax and accounting purposes, but in reality, well-maintained real estate often holds or even increases in value. So removing that paper depreciation gives us a much truer, much cleaner measure of the actual operating cash the company is generating. And when we look at that true cash generation, Ventas hit a full year 2025 normalized FFO of $3.48 per share. The crucial takeaway here is that this marks a very solid 9% increase over the previous year's $3.19. So while net income spiked an insane 184%, the core operating cash flow grew by an incredibly healthy and much more sustainable 9%. Section 2. Driving Growth. Senior Housing. I actually love this quote from Ventas Chairman and CEO Deborah A. Cafaro because it perfectly connects all this macroeconomic data to the human element. She says, "We capitalize on powerful secular demand trends. More seniors than ever are choosing to reside in senior housing for the safety, support, and socialization benefits it provides. This isn't just about clever real estate acquisitions, it's a profound demographic shift. The aging population is accelerating, and they are actively seeking out these community-driven, supported environments." And here is exactly how that demographic shift translates onto the balance sheet. Look at the advantages in their senior housing operating portfolio, or SHOP for short. They delivered over 15% year-over-year same-store cash net operating income, or NOI growth. That's their fourth consecutive year of double-digit growth in this metric. Average occupancy grew by 300 basis points, which is a full 3%. And if you zoom in on just the U.S. portfolio, it's even stronger. 18% cash NOI growth fueled by a massive 490 basis point, or 4.9%, occupancy growth specifically at U.S. independent living communities. People are moving in, and the cash flow is just surging. Section 3. Capital and liquidity strength. Okay, this next number is an absolute showstopper. $5.3 billion. That's the liquidity Ventas had sitting at the ready at the end of 2025. This includes their unsecured revolving credit facility, cash, and unsettled equity forward sales agreements. In the commercial real estate world, this is prime dry powder. It gives them the absolute financial flexibility to just pounce on strategic market acquisitions without over-leveraging themselves.
And they aren't just hoarding that cash either. Ventas aggressively deployed $2.5 billion into accretive senior housing investments in 2025 alone. They even raised $3.2 billion in equity during the year to help fund this growth. All of this active management actually improved their leverage, bringing their net debt to further adjusted EBITDA ratio down to a very healthy 5.2 times by the end of the fourth quarter.
Section 4. The 2026 Forward Outlook. Looking ahead, there's some serious built-in optimism in their forward guidance. Comparing their 2025 actual results with their 2026 midpoint guidance, you can see attributable let income is expected to grow another 6% to 57 cents. But more importantly, look at the normalized FFO. Adjusting for a slight methodology change regarding stock-based compensation, just to keep things apples to apples, they're projecting normalized FFO to climb to $3.83 per share. That's an expected 8% growth rate on top of an already banner year. Now, that 8% growth doesn't just happen by magic. It's built on a few core strategic assumptions for 2026. First, they expect continued significant net operating income growth organically in that SHOP segment. Second, they're planning another $2.5 billion in investments heavily focused on senior housing. And they aren't wasting any time for sure. They've already closed over $800 million in investments right at the start of early 2026. Of course, no business exists in a total vacuum without challenges, and it's super important to look at this objectively. Ventas has baked some headwinds into their 2026 guidance. Specifically, they're navigating the expiry of non-cash rental income from a lease with Brookdale at the end of 2025, as well as the impact of higher net interest expenses across the broader economy. But the key takeaway here is that the immense growth in their senior housing portfolio, along with those new investments, is more than enough to successfully offset these planned hurdles and still deliver that 8% FFO growth. Which brings us to our final thought. With a rapidly growing aging population, is healthcare real estate the ultimate demographic play? Ventas's 2025 financial teardown strongly suggests that if you have the right operational expertise and the capital to scale, providing environments for the longevity economy isn't just an essential social service, it's a phenomenal engine for financial growth. It certainly leaves us eager to see how this macroeconomic sector continues to evolve. Thanks for joining me on this explainer, and keep exploring.